The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to NOVA 401k Associates webinar on Safe Harbor 401k plans. We have included a handout of the slides for your reference throughout the presentation. To access, just click the handout dropdown in your GoToWebinar panel and save a copy to your local computer. Today's presentation will be presented by Don Carr, a team leader and consultant out of our Dallas office, and Lisa Rodriguez, an assistant team leader also out of our Dallas office. If you have any questions, please type them in the questions box and we will answer them at the end of the presentation. Don, we're ready when you are.
Thanks, Jasmine. Welcome everyone to our presentation today on Safe Harbor 401k plans. We're going to talk about what's it all about and go over all the things you may need to know if you're considering switching your regular 401k plan to a Safe Harbor 401k plan. Just our standard disclaimer here that the information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult your qualification after the presentation. Our objectives today are to help you to understand the basic non-discrimination testing for 401k plans. So we'll just be going into some real basics there on how our testing works that we do each year. Also to identify requirements to become a Safe Harbor 401k plan. To learn how to avoid operational problems for when you are potentially a Safe Harbor plan. To recognize the annual requirements to maintain a Safe Harbor plan. And also a new part of our presentation this year is talking about the new Secure Act provisions as far as those provisions relate to Safe Harbor plans. Our chart here just goes over some roles and responsibilities for those of you who may be new to the 401k plan or new to using NOVA services. We have really three components. We have your investment provider. That could be the company that holds the assets in a plan. It could be Transamerica or American Funds, Empower, John Hancock. It's going to be that provider that holds your funds. We actually work with, probably about 20 different providers. So I just kind of named some of the biggest ones that we have. Voya is another big one. So they're going to handle your day-to-day investment transactions. Also, they handle the participant reporting, the quarterly reports, education and communication for your participants. Then you have NOVA, who's your TPA, your third-party administrator. We do the compliance testing and the consulting work on the plan. We come up with the optimal plan design and help you with any changes that you may need to make to the plan design. We also work with your distribution and loans, reviewing those to make sure that they're in compliance with the different laws. We also do your government reporting, your Form 5500, prepare different annual disclosures that need to go out to the participants. And then you have your investment advisor. That's going to be your broker or your person that has the client relationship. They're going to be act as a consultant on the plan, doing annual reviews of your investment options, also involved with your enrollment of new participants. So just an introduction to some of the 401k plan rules here. We have different limits each year, and these are subject to the cost of living adjustments that are usually made in the fall of each year. Right now, for 2020, the employee deferral limit is 19,500. So that's the contribution that the employee themselves make to the plan. And if they're if they're age 50 or older, they're also allowed to do a catch-up contribution. That's 6,500 for 2020. So in the year that somebody turns 50, they're actually allowed to do that catch-up contribution. So they don't need to wait all the way till their birthday that year. It's actually just the year that they're going to turn 50. So somebody could potentially put in 26,000 their own deferral money this year. But unfortunately, because of our different non-discrimination testing, some employees, the highly compensated employees, they cannot actually always contribute these limits because they're going to be limited by the testing, which we're going to go into some examples in the following slide. So as you probably know, 401k plans are highly regulated by the Department of Labor and the IRS, and they're constantly, the Congress is constantly making different changes to the plans, adding new things, adding new rules. So we need to always keep up to date on all the different laws and requirements of the 401k plans. There's basically three tests that we have to think about for 401k plans. There's actually more than this, but this is the three we're kind of going to go into on today's presentation. The ADP testing, this tests the employee deferrals in the plan. It's the average deferral percentage test. And then the average contribution percentage test, which is the ACP test, that tests the matching contributions. There's also the top-heavy testing, and this tests the accumulated balances in a plan to determine whether or not the plan is considered top-heavy. So we're going to go into all of these in a little bit more detail. So you might be asking, what is a highly compensated employee? Because we talk about them all the time, and we just abbreviate them as HCEs. It could be an owner that owns more than 5% of the employer in the plan year or in the prior plan year. It could also be an employee with compensation in excess of 125,000 in 2019. They'll be an HCE for 2020. So you're always looking back to the prior year to see what the compensation was in the prior year for purposes of determining if the person's going to be an HCE for the current year. Also, certain ownership attributes to certain family members of the direct owners working at the company. The attribution could apply to parents, children, spouses, grandchildren. So this is why sometimes we might, tell you that somebody's an HCE, and you might be like, well, they don't, they only make like 30,000 or something like that. But they might be the spouse of an owner, or they might be the child of an owner. So that's why sometimes a person who you might think wouldn't be highly compensated is actually considered a highly compensated for our testing purposes. So the test, the ADP test, it's supposed to demonstrate that the plan does not discriminate in favor of the highly compensated employees with regard to the employee deferral rates of contribution. So just generally speaking, the HCE average must be within 2% of the non-HCE average. So it is allowed to be a little bit higher on average, but it can't be excessively higher. If you fail this testing, there is corrective action needed. And refunds are the most common that we see, refunds to the highly compensated employees. And those need to be done typically for a calendar year plan, they need to be done by March 15th of the following year. So that's why we always need to get the census information as soon as possible in January or February so that we can get that testing done in case there are any refunds that we can get them done in time. because if you don't get the refunds done in time, there's actually penalty with the IRS for that. Another option, a corrective action, would be additional contributions to the non-highly compensated employees or the non-HCEs. This happens sometimes, but it's not as common because usually the company's not interested in giving, these additional contributions to the non-highly compensated, especially if they're going to be higher amounts. Sometimes if the amount's not too high, we do see that on occasion. So just a sample testing example here. You have, in this example, only 2 HCEs, and if you look at their compensation and their deferral amount, and then you can see that their ADP percentage, which is the percent of the deferral to the compensation for each person, and then you have to add them up, and then you take an average. So the average in this case is 9.5, which is actually pretty high. But then if you look at your non-HCEs, you take the average of, you take the percentage of each of those, and you take the average, and you come out with 4.25. And you can see in this example that non-HCE number 3 doesn't make any deferral. So that's bringing down your average because they're being counted as a 0. So you can see there's a pretty big disparity here, 9.5 and 4.25. So we're showing the next slide, but that's going to fail your testing. So in that example, the maximum ADP of the HCE group would be 6.25, which is the non-HCE average of 4.25 plus 2. But the test fails since the HCE group is actually deferring an average of 9.5, which is greater than that permitted 6.25. So in that case, you're going to need to take some sort of corrective action, which we had mentioned before. It could be the refunds, or it could be an additional contribution to bring the non-HCEs up. So that was just a small group, but if you're looking at 100 people, you could see where that extra contribution to the non-highlies could be pretty substantial. Now, the top-heavy test is another important one for our purposes here. The plan is considered top-heavy when the total account balance of your key employees exceeds 60% of the total overall account balance. So that means that your key employees, which is mostly your owners, but it could go into a little more detail on what that is in a minute, but they have 60% or more of the total value of the plan. And that's not just your contributions in the current year, that's the total account balances that have accumulated in the plan. So some people might consider that good, some people might consider it bad. It's kind of both. I mean, in some ways, the owners are happy because they have the bulk of the balance in the plan, but you also run into additional compliance issues when the plan is top heavy. So what is required when a plan is top heavy is that all the eligible non-key employees who are still employed at the end of the year are required to receive a minimum contribution. So you could picture how that could be somewhat expensive depending on how many employees you have in a plan. And top heavy, unlike your ADP testing, it cannot be stopped by giving refunds. You have to make that required employer contribution. And this could be sometimes a bit of a shock at the end of the year if you come to find out you're top heavy, that you can't solve it any other way besides making these additional contributions to your non-HCEs. And that's generally going to be 3% of their compensation. It could sometimes be less if all the key employees contribute less than 3%, then it's the highest contribution percent of any key employee. But almost 99% of the time, it's going to end up being 3%. And we do a lot of emails and things like that to alert you if your plan seems to be getting close to top heavy. But sometimes this can be a problem in the very first year of the plan. It could be a kind of it could be a big surprise if you're start a new plan in 2020 and you're already top heavy right away. So that's something that to consider when we look at possibly doing mid-year testing on new plans. So, kind of skipping ahead to safe harbor plans. If you don't want to have to worry about your ADP testing or your top heavy testing, you might want to consider switching to a safe harbor 401k plan. And these were added into the law back in 1999, which I know it seems like a really long time ago to some people. And then in addition to that, in 2006, the PPA added an additional safe harbor for auto enrollment 401k plans, and that was called the Qualified Automatic Contribution Arrangement, the QACA. So we'll be going into the different types of safe harbor in a few minutes, but just to give you a little background on them, they have been around for a while. So the benefit of the safe harbor 401k plan is that if a 401k plan satisfies certain conditions, it's deemed to pass the ADP test, the ACP test, and the top heavy test. So that you can see where this would be really beneficial to the highly compensated and potentially to the company itself, because your ADP and ACP testing would be deemed to pass. Your top heavy requirement would be satisfied, and your HCs could contribute the maximum deferral without worrying about the refund. So, like we talked about before, the $19,500, or if they're over 50, the additional $6,500. So all your HCs could put in the maximum, and you wouldn't have to worry about potentially failing the testing. It is slightly more complicated than that because it only will pass all these tests if you only make the safe harbor contribution. So if you go ahead and then also make, say, a profit sharing, then the top heavy requirement comes back. So you still have to watch out for top heavy. But generally, if you're making that additional profit sharing, you'll be giving the employees the 3% anyway. So it's just something that, just think about, that it's deemed to pass the top heavy testing only if all you do is if the only employer contribution you have is the safe harbor contribution. One of the big requirements of the safe harbor is an annual notice requirement. This has to be provided at least 30 days before the first day of the plan year. So for a calendar year, you're looking at providing this by December 1st to let employees know that you're going to be a safe harbor, and also has to let them know what type of safe harbor you're going to be, to specify the type of employer contribution. And there's also a 100% vesting requirement for safe harbor plans, with the exception of the QACA that we talked about. On that one, you can have a 2-year cliff vesting. We'll be going into the different types of safe harbor in a minute. There's also certain withdrawal restrictions to safe harbor contributions. So with safe harbor, it was always very limited as to what you could do mid-year on any changes or elections to safe harbor. Existing 401k plans, like a plan that was already a regular 401k plan, they can only add a safe harbor contribution on the first day of the next plan year. So in the past, you could never add a safe harbor during the year, you always had to add it before the beginning of the year. An exception to that was with a brand new 401k plan or even an existing profit sharing only plan. They had to be a safe harbor for at least 3 months of the plan year. So for a calendar year, they would have to have that in place by October 1st. And there has been some changes over time. And towards the end of the presentation, we're going to talk about the Secure Act and how that made some changes to the notice requirements and the election requirements for safe harbor plans. Also, it's very limited as to what type of things you can change during the year for a pre-existing safe harbor. And these rules have changed a little bit over the past few years. So if you do want to make any changes to your plan, it's best to talk to your account manager just to see if that's going to be permitted under the safe harbor rules. So let's look at an example here for option 1, a matching safe harbor formula. So what they call the basic safe harbor match, it's 100% match on the first 3% of employee contributions plus 50% match on the next 2%. So if you think about a person who puts in 5% deferral, they would be getting a 4% match because they would get 100% of the first 3 and then 50% of the next 2. That's the most common one. That's the most common safe harbor match formula because it's actually the lowest cost other than the QACA, which we'll talk about in a minute. And then you have enhanced match, safe harbor match. That's 100% match of deferrals up to 6%. So it could be 100% up to 4% or 5% or 6%. So if you think about it like that, it's just a little bit easier maybe than the tiered basic match. Like if you had a 4%, it would be just easier to explain to people 100% up to 4%. But if you go over that 6%, it drives the plan back into being subject to the ACP testing. So that kind of defeats some of the purpose of doing a safe harbor because it pulls you back into the testing again. So in these matching safe harbors, only your employees who contribute will receive the match. And it's really the preferred safe harbor for companies where they're not planning on making any additional employer contributions. So they're just going to be doing the employee deferrals and the safe harbor match. Option 2 is called a non-elective safe harbor formula. So it has to be at least 3% of compensation, which you might remember back to the top heavy we talked about before. That's kind of that 3% again. So employees who do not have to contribute their own money to receive the contribution. So that's going to be all your eligible participants will be getting this 3% safe harbor. And that's the preferred method when your owners are highly compensated, have intention to receive the maximum allocation for the year. For 2020, it's $57,000. So they would have to do that in combination with the profit sharing. So a lot of times, if the company already knows it's going to be making a profit sharing, the 3% safe harbor will often work out a little bit better than the safe harbor match. But the drawback to it, though, is pretty big, is that you have to give it to everybody who's eligible, not just the people who contribute their own money. Now, the QACA safe harbor formula, it's it's a little bit different. You could do either a 3% non-elective, just like we talked about before, or you could do a tier matching that's a little bit different than the basic match. It's well, it basically comes out to 3.5%. So it's a little bit lower than your basic match, where you might have to give people 4%. So you could do like 100% match on 1% of compensation, and then you could do 50% match up to 6%. So it's a little confusing. You could word it a couple different ways, but it basically works out to be that you would have to give people who are deferring at least 6%. You'd have to be giving them 3.5%. But there's a lot of additional rules you have to meet to be a QACA. It's an auto enrollment type plan where you would have to automatically enroll the employees. So that could be good because it could bring up your participation. So it's something to think about if you were leaning towards doing an automatic enrollment plan. So here's an example on the basic match. If somebody's compensation is $50,000 and they did a $4,000 deferral, that's an 8%. Then you would do an employer match of 100% at the first 3, and then 50% on the next 2. So just a simple calculation here. You would do 3% and then 50% of the next 2. Comes out to 2,000. But I mean, another way to look at it is the person's deferring more than 5%, so they're going to get a 4% match. So if you see somebody's deferring, 5% or more, you just know they're going to be getting a 4% match. On the enhanced match, it's a little easier actually. This one, it's 100% on the first 6% of pay. So the same person, $50,000, $4,000 deferral, they would be getting a $3,000 match. So it's higher. You're giving them more than you have to meet the requirement. But I guess it could. Some people might, want to do a higher match or a higher match of 4%, or they may already have been doing something like that. So it could be intended to, replicate something that the company had done in the past. As far as the non-elective safe harbor, the same person at 50,000, but they don't make any deferral, they're still going to get the 3%. So it's going to be 1,500. So just to keep in mind on this one, it goes to all eligible employees. So it's regardless of whether or not they contribute their own money. As I mentioned before, there's also certain vesting requirements on the safe harbor. Generally, it's going to be 100% vested, whether it's the matching or the non-elective. They still have to be 100% vested at all times. The QACA plan is the only one that's a little different. That one has to be 100% vesting after 2 years. So it's not a huge difference, but it could be a good one to do if you didn't want to do immediate 100% vesting. All your other employer contributions, like if you had a regular match or if you had a profit sharing, they're still going to be subject to your regular vesting schedule. The QACA has additional requirements, like I mentioned before. It has to be an auto enrollment plan. So you have to have auto enrollment at a minimum default percentage. It's going to be 3%, and a maximum up to 10%. There was a change made with the Secure Act, which is going to come up later in the presentation. Increasing that maximum, but the main thing to keep in mind here is you have to have the minimum auto enrollment percent of 3. And then you also have to have something called auto escalation, which is where if your default rate is less than 6, You have to increase the auto-enrolled participants every year until they get to 6. So if you start at 3, then the next year go to 4, 5, 6. But then once you hit 6, you don't have to escalate them anymore, but you can continue to escalate them up to the maximum of 10, or, with the change to the Secure Act, the maximum goes up to 15. So that's some main things with the QACA. But most of the investment providers now can accommodate the auto escalation, but that would be something to confirm before you switch over to this type of plan, just to make sure. And that's something your account manager can help you with, just to make sure that the investment provider would be able to accommodate that. There are some withdrawal restrictions for safe harbor contributions that are similar to the deferral restrictions. So if you're familiar with those, it's very similar. For example, you have to be at least 59.5 to be able to do an in-service withdrawal, or you'd have to be terminated from employment. There's another provision that allows participants who were default enrolled in a QACA to take what they call a permissible withdrawal of their automatic contributions within 90 days of being auto-enrolled. So that's just so if a participant gets default enrolled and then, they come back to you right away and say, why did you take this money out of my check? You'll be able to return that to them as long as it's within the 90-day period. So as I mentioned at the beginning, there are annual notice requirements. A safe harbor status is a year-to-year election, so you do have to have an annual notice requirement. Has to be given out to all eligible participants at least 30 days and not more than 90 days prior to the beginning of each safe harbor plan year. Also, newly eligible employees must be notified no later than their date of eligibility, but no earlier than 90 days before the eligibility date. So usually, like I said, for the annual notice, it goes out by December 1st. And then for newly eligible, it would go to them on their date of eligibility. But I mean, potentially you could give it to them like up to 90 days before they're eligible, but you can't give it to them so many days before they're eligible that they're not going to even remember it. So if you have like a 1-year wait to get in the plan, you can't just give them the notice like when they're hired, and then even though they wouldn't be eligible for a year. I think that's kind of why they have this 90-day before eligibility date. There's certain key information that has to be in the notice. So the formula, you're going to have to say whether it's a basic or enhanced or the QACA, the employee contribution limits, other discretionary employer contributions. You have to name the plan that the contributions are made to, the definition of compensation, that withdrawal provision information, the vesting provisions, and that would be, your vesting even for non-safe harbor type of contributions. And then at the bottom, it'll usually have the plan contact information. But you don't have to worry about all that. If you become a safe harbor plan, our document department actually prepares the notice. But just to give you an idea of the type of things that go in the notice. At this point, I'm actually going to be switching the presentation over to Lisa. So thank you again, and I'm going to switch it over to Lisa.
Thanks, Dawn. Can y'all see my slides?
Dawn?
Okay, perfect, thanks. Okay, so let's move on to some of the operational problems you should try to avoid. I've listed 3 here, and then we'll go over in details on each one on the next couple of slides. So the first one is safe harbor matching contributions may need to be limited due to the annual compensation cap of $285,000 for the 2020 year. And 2, safe harbor contributions must be deposited to the correct source. 3, do not match the catch-up contributions separately from the regular employee deferral contributions. So the first one I mentioned is the compensation limit, and it's capped at $285,000 for 2020. This means that you cannot use any compensation above $285,000 when calculating the safe harbor contribution. The IRS may index the limit from year to year. We have seen it increase about $5,000 each year in the past for the past couple of years. With that being said, NOVA will inform you of new IRS limits in the 4th quarter of each calendar year. So we'll keep you updated on any limit changes. Let's go over an example. So Acme 401k plan makes a dollar for dollar match, safe harbor match contribution on the first 4 contributed by the employees. This means that the maximum match anyone can receive for the 2020 year is $11,400. And you can take the $285,000, which is the maximum comp limit for 2020, multiply it by 0.04, and that's how you will get the $11,400. Note, any safe harbor matching contributions over the $11,400 will need to be forfeited along with any earnings or losses. And the second problem you should try to avoid is depositing safe harbor match contributions into the wrong source. So be very careful when you upload the contributions to the record keeper's website. 401k plans are legally required to separately account for different contribution types. It's very important to avoid this error, as each source does have different distribution options. Each source has a different vesting schedule as well. For example, employee deferral contributions, Roth contributions, both of those contribution types are 100% vested. Match and profit sharing have a different vesting schedule. You may want to check the plan document to confirm what vesting schedule those 2 sources have. Safe harbor match contributions, safe harbor non-elective contributions, those 2 sources are always 100% vested. So the third problem to avoid, do not try to separate the catch-up and the non-catch-up deferral contributions when trying to determine the safe harbor match. You'll end up getting and calculating the wrong safe harbor contribution. What you need to do is, get both the catch-up amounts and the non-catch-up employee contributions should be added together in determining the employee's deferral rate, and then you can calculate the safe harbor match contribution. This same thing applies with Roth contributions and non-Roth employee contributions. They're both calculated the same way. In the event the plan sponsor calculated the wrong match, you will need to work with your payroll provider, or if you do it internally with the internal person, to correct the issue. Note that the tiered safe harbor match formula is a very common formula, but can sometimes be calculated incorrectly. So feel free to contact your account manager if you have trouble determining how the safe harbor match is calculated. So now let's move on to the Secure Act, as it did bring some changes to Safe Harbor 401k plans. Now, this Secure Act was passed into law at the end of 2019. It eliminates the notice requirement for the Safe Harbor non-elective feature, and although you still need to distribute the notice for the Safe Harbor match, including the QACA match. And you still have to distribute a notice for any Safe Harbor plans that are also funding a discretionary match, or any Safe Harbor plans that are considered a maybe Safe Harbor plan. This act is effective for plan years beginning after December 31st of 2019, allowing for a retroactive amendment that may be adopted as late as December 31st, 2020. And lastly, you can continue to distribute the Safe Harbor notices for the Safe Harbor non-elective feature. That's okay, even though it's not a requirement. It's okay to do so. The Secure Act allows for the following mid-year Safe Harbor non-elective contribution adoptions. One, the ability to switch to a Safe Harbor non-elective plan mid-year. Two, you can amend up to 30 days before the end of the current plan year to be a Safe Harbor plan for that year. Three, a required contribution of 3% of gross pay, which is retroactive to the beginning of the plan year, which is January 1st of 2020. And here's an example of a mid-year change. Let's say in mid-2020, NOVA prepares a mid-year test for your plan. The mid-year test indicates that it failed, and you're required to take a large refund for projected number of highly compensated employees. You would have up until December 1st of 2020 to amend the plan and become a Safe Harbor non-elective plan for 2020. All eligible employees will receive a contribution of 3% of the compensation, and the plan will no longer need refunds for the year. Now, the Secure Act also allowed for late adoption of Safe Harbor non-elective plans. It's the ability to actually switch to a Safe Harbor non-elective plan for the pre-citing plan year after the close of the plan year. Now, an amendment must be adopted before the end of the following plan year, which is up to 12 months after the testing year. A 4% Safe Harbor non-elective contribution retroactive to January 1st would be required, and the late adoption also applies to any QACA Safe Harbor non-elective plans. Okay, so here's an example of a late adopter. Let's say in 2021, NOVA prepares the required ADP testing and failure with large refunds is determined to be necessary for the highly compensated employees. You can now amend your plan to a 4% Safe Harbor non-elective plan for 2020 after the plan year has ended to eliminate the refunds. So the amendment does have to be signed prior to 12/31/2021 to actually, adopt this feature. The Secure Act also brought changes to QACA plans. Auto escalation was increased from 10% of compensation to 15% of compensation. Now, there was no change to the employer contribution. The plan will need to be amended to implement the auto escalation increase, if you're interested in that option. Now, the change is not mandatory. Therefore, plans currently capped at 10% can actually stay at 10%. So you may be asking yourself, is the plan a good fit to be a Safe Harbor plan? If any of the following apply, then yes, you should definitely consider adding the safe harbor feature. 1, do you constantly fail the annual ADP or ACP non-discrimination testing, resulting in refunds to highly compensated employees? 2, do you have low participation rate for non-highly compensated employees? Is your plan a top-heavy plan for the year? Do you want to bring in key employees to the IRS maximum limit? And it's $57,000 for 2020. Are you already providing employer contributions into the plan? And do you have a good, steady cash flow? Again, these are some reasons why you may want to consider to be a safe harbor plan. Okay, so below are some examples of companies that may be top-heavy and should probably consider a safe harbor feature. 1, employer-operated businesses. If your business is family-ran, may want to consider the safe harbor feature, as well as any medical or legal practices, small companies with a few highly paid owners, and small number of low-wage staff members, even companies with low non-highly compensated participation should consider being a safe harbor plan. Let's see, an amendment is required in order to be a safe harbor plan. So if you would like to proceed in adding this feature, contact your account manager as soon as possible, as the plan does need to be amended by December 1st of 2020. There is a required notice that does need to be distributed by December 1st of 2020 as well. You'll need to allow participants to make new elections for the upcoming plan year. You must notify the record keeper to set up a safe harbor contribution source for the plan. You also have to notify your payroll department, whether if it's internal or external, that you're adding this safe harbor feature. And this concludes our presentation. As a reminder, the webinar is eligible for CE credit. You'll receive an email with a link to the evaluation form. Make sure you return the evaluation form to get credit. You should receive a certification within 1 week of the presentation. Jasmine, do we have any questions?
Hi, Lisa. We haven't received any questions yet. Please, if anybody does, enter those into the questions box if you can. We do need to keep going about 3 more minutes to hit our 50-minute mark if you guys want to talk about something else.
Also, just for everyone on the webinar, if you go to our NOVA website, we do have other webinars. I know next week we have an intro to 401k for plan sponsors. That one's a great one if you have somebody new working in your HR or with your 401k, or if you just like, as a plan sponsor, would like a quick refresher. It goes over various subjects like distributions and loans, eligibility, issues with rehires. We also do have our NOVA YouTube channel. If you just go into YouTube and search NOVA 401k Associates, you can actually subscribe to our YouTube channel. And there are several past webinars, such as the intro one from past times. That's a quarterly webinar. We do have that one available. We have the loan and distributions webinar. It's a webinar specifically just concerning loans and distributions, as well as other topics. If you do want CE credit, please make sure after an hour, so at about 3 o'clock, you will receive an email with a link to a survey. Please make sure to complete that survey, and that way we know to provide you your CE certificate. We will send out your certificate within 1 week. So if you don't receive your certificate by Friday of next week, please send an email to webinars@nova401k.com, and we will be happy to get that over to you. Also, if you requested a link for the recording, we will also send you that link when it is available. It does take us about a week to a week and a half to actually get the recording available on our YouTube channel to provide. But if you review this information and you have any other questions, you can contact Lisa or Dawn. Their contact information is available on the screen shown, or please reach out to your NOVA account manager. If you do not know who your NOVA account manager is, you can always email us at webinars, and we will provide you your NOVA account manager contact information. All right, well, it looks like we still haven't received any questions. Dawn or Lisa, did y'all have any closing comments?
The only thing, this is Dawn, the only thing I wanted to mention is that we are looking at doing mid-year testing at this point. If there's any companies that are interested in having us do a mid-year test, please reach out to your account manager. At that point, we could see if the testing looks like it's going to fail, or if there's any corrective actions you might need to take by the end of the year. It would be better to find out now, you know, in case you need to take some sort of action before the end of the year. But again, thank you everyone for joining us for our presentation today.
All right, well, thank you everyone for attending. Everybody have a great rest of your day.